This is India's #1 news network, and you're watching News 9. English news as it should be.
Good morning. This is News 9 and we are bringing you the special broadcast today as RBI Governor Sanjay Malhotra is slated to go live at 10 a.m. with the outcome of the first Monetary Policy Committee meet of this financial year, FY26. What is likely to be India's GDP growth forecast? We'll bring you that on the show. We'll also get a sense of which direction is inflation likely to be headed in India for FY26 and decoding what the policy stance of RBI and whether it will change from neutral to accommodative or not, and what that will mean for you, for your home loans, your EMIs and your fixed deposit interest rates. All of that will be decoded on the show today with three experts who are joining us. We'll have Vivek, Kumar, economist at Quantico, Indranil as well as Avinash, Gorakshakar. Let's cut to RBI Governor Sanjay Malhotra live.
Committee overall. The year has begun on an anxious note for the global economy. Some of the concerns of the trade frictions are coming true, unsettling the global community. We at the Reserve Bank, while remaining alert to these global developments, began the year celebrating the completion of 90 years of this august institution since its inception way back on 1st April 1935. The Reserve Bank's journey over the last 9 decades is closely intertwined with the nation's development and progress. As a custodian of monetary and financial stability, the Reserve Bank has evolved itself over the years into a full-service central bank with varied functions facilitating a market economy. Indeed, a very, very long journey full of accomplishments and achievements, something which every RBI is proud of, and something I believe the whole of India and its citizens are also proud of. In this challenging global environment, the Monetary Policy Committee met on the 7th, 8th and 9th of April today to deliberate and decide on the policy repo rate. The global economic outlook is fast changing. The recent trade tariff related measures have exacerbated uncertainties, clouding the economic outlook across regions, posing new headwinds for global growth and inflation. Amidst this turbulence, the US dollar has weakened appreciably, bond yields have softened significantly, equity markets are correcting, and crude oil prices have fallen to their lowest in over 3 years. In fact, as we speak, it is about $60 to a barrel. Under these circumstances, central banks are navigating cautiously with signs of policy divergence across jurisdictions, each reflecting their own domestic priorities. The Indian economy has made steady progress towards the goals of price stability and sustained growth. On the inflation front, while the sharper than expected decline in food inflation has given us comfort and confidence, we remain vigilant to the possible risks from global uncertainties and weather disruptions. Growth is improving after a weak performance in the first half of the last financial year, 24-25, although it still remains lower than what we aspire for. And now I come to the decisions of the Monetary Policy Committee. After a detailed assessment of the evolving macroeconomic and financial conditions and outlook, the MPC voted unanimously to reduce the repo rate by 25 basis points to 6% with immediate effect. I repeat, the MPC voted unanimously to reduce the policy repo rate by 25 basis points to 6% with immediate effect. Consequently, the standing deposit facility, the STF rate under the liquidity adjustment facility adjusted to 5.75%, and the marginal standing facility rate or the MSF rate and the bank rate shall stand adjusted to 6.25%. I shall now briefly set out the rationale for the decisions of the Monetary Policy Committee. The Monetary Policy Committee noted that the inflation is currently below the target. It is supported by a sharp fall in food inflation. Moreover, there is a decisive improvement in the inflation outlook. As per projections, there is now a greater confidence of a durable alignment of headline inflation with the target of 4% over a 12-month horizon. On the other hand, impeded by a challenging global environment, growth is still on a recovery path after an underwhelming performance in the first half of 24-25, which is the last fiscal. In such challenging global economic conditions, the benign inflation outlook and the moderate growth demand that the MPC continues to support growth. Accordingly, the MPC unanimously voted to reduce the policy repo rate by 25 basis points to 6%. Moreover, it also decided to change the stance from neutral to accommodative. It also noted that the rapidly evolving situation requires continuous monitoring and assessment of the economic outlook. Let me now dwell a little on the monetary policy stance. This has been a subject of interest for some commentators and market participants. There have been questions as to whether it means a change on the policy rate or whether it signifies our stance on the interest rate or whether it relates to liquidity conditions. From a cross-country perspective, monetary policy stance is typically characterized as accommodative, neutral, or tightening. While an accommodative stance entails easy monetary policy that is geared towards stimulating the economy through softer interest rates, tightening refers to contractionary monetary policy, whereby interest rates are hiked to restrain spending and curb economic activity, all with the objective of reining in inflation. A neutral stance is typically associated with a state of economy which neither calls for stimulating economic activity nor calls for controlling inflation by curtailing demand. Therefore, it provides the flexibility to the central bank and the MPC to move in either direction on the basis of the evolving economic conditions. In our context, the stance of monetary policy signals the intended direction of the policy rates going forward. Accordingly, with respect to the policy rate, which is the mandate of the MPC, today's change in stance from neutral to accommodative means that going forward, absent any shocks, the MPC is considering only two options, that is status quo or a rate cut. Let me also clarify that the stance should not be directly associated with liquidity conditions. While liquidity management is important for monetary policy, including decisions related to policy rate, it is an operating tool with the RBI for various purposes, including monetary policy transmission. Monetary policy decisions to change policy rates do, however, have implications for liquidity management, being the operational tool to carry out the policy changes. To summarize, our stance provides policy rate guidance without any direct guidance on liquidity management. I will, of course, be discussing later our approach to management of liquidity. Before now I share our outlook, and assessment of the growth and inflation, I think a few words on the implication of the recent global trade and related policy uncertainties are in order. Let me first highlight the possible implications for growth. First and foremost, uncertainty in itself dampens growth by affecting investment and spending decisions and households. Second, the dent on global growth due to trade frictions will also impede domestic growth. Third, higher tariffs shall have a negative impact on net exports. There are, however, I may say, several known unknowns. The impact of relative tariffs. Our relative tariffs vis-a-vis some of the other countries are quite low. Then there is the unknown of the elasticities of our export and import demand and the policy measures adopted by us. You are all aware that India is very vigorously and proactively engaging with the US administration on the foreign trade agreement. These are just to name a few. These make the quantification of the adverse impact on growth difficult. The risks to inflation, on the other hand, are two-sided. On the upside, uncertainties may lead to a possible currency pressure and therefore imported inflation. On the downside, slowdown in global growth could entail further softening in commodity and crude oil prices, putting downward pressure on inflation. Overall, while global trade and policy uncertainties shall impede growth, its impact on domestic inflation, while requiring us to be vigilant, is not expected to be of high concern. Coming now to our growth outlook, real GDP, as you are all aware, this year, as per the MOSPI figures, is expected to grow at 6.5%. This is on top of a 9.2% growth rate observed in the previous year, which is 24-25. In 25-26, the current year, prospects of agriculture sector remain bright on the back of healthy reservoir levels and robust crop production. Manufacturing activity is showing signs of revival, with business expectations remaining robust, while services sector activity continues to be resilient. On the demand side, bright prospects of the agriculture sector bode well for rural demand, which continues to be healthy, while urban consumption is gradually picking up with an uptick in discretionary spending. Investment activity has gained traction and is expected to improve further on the back of sustained higher capacity utilization, government's continued thrust on infrastructure spending, healthy balance sheets of banks as well as the corporates, along with the easing of financial conditions. Merchandise exports will be weighed down by global uncertainties, as mentioned earlier, while services exports are expected to remain resilient. Headwinds from global trade disruptions continue to pose downward risks. Taking all these factors into consideration, real GDP is now projected for this fiscal 25-26 at 6.5%, with Q1 at 6.5%, Q2 at 6.7%, Q3 at 6.6%, and Q4 at 6.3%. While the risks are evenly balanced around these baseline projections, uncertainties remain high in the wake of recent spike in global volatility. You would have noted that the growth projection for the current year has been marked down by 20 basis points relative to our earlier assessment of 6.7% in the February policy. This downward revision essentially reflects the impact of global trade and policy uncertainties, which I had highlighted a little while ago. Coming to inflation, the headline inflation moderated during January-February 2025 following a sharp correction in food inflation. The outlook for food inflation has turned decisively positive. The uncertainties regarding rabi crops have abated considerably, and the second advance estimates point to a record wheat production and higher production of pulses over that last year. Along with robust kharif arrivals, this is expected to set the stage for a durable softening of food prices. Sharp decline in inflation expectations in our latest survey for 3 months and 1 year ahead would also help anchor inflation expectations. Furthermore, the fall in crude oil prices augurs well for the inflation outlook. Concerns on lingering global market uncertainties and recurrence of adverse weather-related supply disruptions, however, pose upside risks to the inflation trajectory. However, I may add that as per the latest forecast by various organizations, national and international, including our own Indian Meteorological Department, the monsoon is expected to be normal, and the El Nino effect is also expected to be absent. So these are positives for us. Taking all these factors into consideration and therefore assuming a normal monsoon, CPI inflation for the financial year 25-26 this year is projected at 4%, with Q1 at 3.6%, Q2 at 3.9%, Q3 at 3.8%, and Q4 slightly higher at 4.4%. The risks are evenly balanced. I now will be speaking on the external sector. India's services exports remained resilient in January-February of this year, driven by software, business, and transportation services. Going forward, net services and remittances receipts are expected to remain in large surplus, partly offsetting the trade deficit. The current account deficit for last year as well as this year, 25-26, are expected to remain well within the sustainable level. On the financing side, gross foreign direct investment, FDI, remained strong during the period of April 24 to January 25. Last year, which is the latest data, period for which we have the latest data, reflecting India's strong macroeconomic fundamentals. Net FDI, however, moderated sharply during this period due to higher repatriations and outward FDI. Net FPI inflows to India stood at $1.7 billion during 24-25, supported by debt inflows as the equity segment recorded net outflows. This is much lower than what we had last year. External commercial borrowings and non-resident deposits, on the other hand, witnessed higher net inflows compared to that last year. As on 4th April 2025, India's foreign exchange reserves stood at $676.3 billion, providing an import cover of about 11 months. Overall, India's external sector remains resilient as the key indicators stay robust. I will now be talking about the liquidity and the financial market conditions. System liquidity was in deficit in January 2025, with net injection under the liquidity adjustment facility scaling a peak of more than 3 lakh crore rupees, in fact 3.1 lakh crore rupees on 23rd January 2025. However, as a result of a slew of measures, and I'll not go into the details thereof, you are all aware of them, of the various OMOs, the CRR rate cut, the swaps that we have done. The system liquidity deficit tapered, therefore, during the last 2 months of February and March, and further it turned into a surplus on 29th March 2025. Further, coupled with the government spending picking up pace during the latter half of last month, March. The system liquidity further improved and it stood at a surplus of 1.5 lakh crore as on 7th April 2025, and even yesterday it was 1.4 lakh crore rupees of surplus. Reflecting these developments, the weighted average call rate softened and remained near the repo rate since the last policy meeting. The spreads of 3-month CP and 3-month CD rates over the 91-day Treasury bill rate have also softened since the second half of March, suggesting an improvement in liquidity conditions. I would like to mention over here again, I am reiterating this, I have said this earlier, which is that the Reserve Bank is committed to provide sufficient system liquidity. We will continue to monitor the evolving liquidity and financial market conditions and proactively take appropriate measures to ensure that there is adequate liquidity in the system. Coming to financial stability, well, I do not have much to add from my previous policy statement in February. Things are more or less looking similar. The financial soundness parameters of the banking sector continue to be robust. The liquidity buffer in the banking system is well above the regulatory threshold. Profitability indicators are also healthy, reflecting robust operational efficiency of the system. Similarly, the system level parameters of NBFCs too are very sound. Now, as has been the practice, I shall be announcing some additional measures. This time I have 6 additional measures to announce to all of you, and these relate to banking regulation, fintech, and payment systems. First, we propose to enable securitization of stressed assets through market-based mechanism. There is already a mechanism of securitization of standard assets. The same is now proposed to extend with modification to stressed assets, and I may add that this is in addition and this is not in lieu of the existing ARC route under the SARFAESI Act of 2002. Second, we have guidelines on co-lending. They are presently applicable only to arrangements between banks and NBFCs. Moreover, they are restricted to priority sector loans. To exploit the huge potential of such lending arrangements, it is proposed now to extend these to all regulated entities and to all loans, priority sector or even outside the priority sector. Third, loans against the collateral of gold jewelry and ornaments, commonly known as gold loans, are extended by regulated entities, both banks and NBFCs, for both consumption.
RBI Governor Sanjay Malhotra there live telling us the outcome of the first Monetary Policy Committee meet of this financial year FY26. A lot of important news coming in. Number one, the growth projection for the GDP growth projection for FY26 has been revised downwards from the earlier estimate of 6.7% to just 6.5%. And Sanjay Malhotra there also saying that tariffs and global headwinds are likely to impede growth. Well, we have a special guest joining us this morning to decode this and help us understand the finer points of the commentary coming in from RBI Governor Avinash Gorakshakar, Head of Research at Profit Mart Securities, joining me this morning. Avinash, good morning. Thank you so much for joining us on this very important day. Headlines first, inflation likely to ebb down to 4%, but GDP growth projection from 6.7% now revised to 6.5%. But the stance, the policy stance of RBI has been shifted from neutral to accommodative, meaning rate hikes are unlikely to happen despite inflation that could be imported from the US. Your first thoughts, sir?
Yeah, good morning. See, my sense is I think the policy by the RBI has been in line with what the market was expecting. My sense is I think, typically if you look at the commentary of the governor, it is very clear that maybe for a quarter or two, I think unless global headwinds settle down, I think we may not be able to see any fast growth for the Indian economy. I think the near-term trigger would be the corporate result season, which is expected to start from tomorrow. So I think we'll have to take a call on a stock to stock specific basis. On a broader index level, I think, the Indian economy is definitely going to face the heat as far as the tariffs issue are concerned. And I think, hopefully if there is some free trade agreement or some negotiation with the US, we could get some indication by September. So I think, as of now, the markets will be volatile. I think the markets are definitely happy to hear that rate cuts have happened, and the governor is positive and constructive on the Indian economy. But I think with crude prices touching new lows, fears of a global recession, I think you'll have to wait for some time before we see some concrete numbers, improving in the positive trajectory. So I think, the domestic themes would be in focus. Companies which are on the export market side, especially IT, pharma, auto components. Typically, these are sectors, where possibly one could see a lot of volatility in the coming at least 1 or 2 quarters.
RBI governor had specifically mentioned service exports and saying that service exports are likely to remain robust. 526. That's not really the story that has been playing out for IT stocks ever since Donald Trump induced recession has been making headlines, and the likelihood of that, or the probability of that, also increasing, day after day, week after week. So IT stocks not faring well at all for a considerable period of time now, Avinash. And recession means, and any inflation in US entail that the IT services in India will take a beating.
No, exactly. I think in the short term, there's going to be definitely a negative impact on the US economy, because as everyone is aware, US, has been importing a lot of products and services from countries like India in terms of manufactured products. China is a very large trading partner. So I think, once tariffs are announced, obviously inflation is going to get elevated. And I think anything which attracts inflation and becomes expensive, I think obviously has an impact on demand. So my sense is, at least for the next 1 or 2 quarters till September, the IT sector may continue to face considerable amount of headwinds. And I think the fourth quarter numbers which are expected, tomorrow TCS is coming out with their fourth quarter numbers. I think more than the numbers, the management commentary and the outlook shared by the management is going to be very important. So I think, till that time, the large cap IT companies, the mid cap IT companies, obviously, which have got a large exposure on the US market, may see a little bit of selling pressure unless and until we see improvement in the numbers, because growth quotient, at least for the next 1 or 2 quarters, seems to be a little cloudy. So I think it would be wise for investors to be cautious here. I think rather than jumping the gun, it's better to wait for the Q4 numbers to come out and understand the commentary, and then take a, kind of a proactive call on the sector and particular companies.
All right. And talk to us, Avinash, what are you making of the BFSI pack, the finance pack on Nifty 50 this morning? Because that is not taking the news perhaps too well of a rate cut and a change in stance. That seems a little counterintuitive. Or is it something to do with their deposit growth that was seen in FDs, now possibly likely to fall because people may not want to explore fixed deposits as an option when the repo rate gets cut?
So I think, more than the deposit rate cut, I think markets are fearing that if at all the global economy goes in a recession and India is not able to work out any negotiating deal with the US on the tariff issue, then I think it's going to obviously impact, demand. It's going to impact margins. And if inflation goes up here, I think although the RBI governor is quite positive that inflation will be targeted at around 4%, my sense is that, I think in the economy, unless we have a very strong monsoon, a very strong rural demand, I think the markets will be elated once the April to June quarter numbers are out. The March quarter numbers, according to me, are unlikely to be very robust. At best, we could see flat numbers coming out. And I think more than the numbers, the commentary will be important. So today's rate cut was on expected lines. No big positive surprises. And I think the commentary from the governor was quite cautious. I think he clearly indicated that global uncertainties have increased. Imported inflation could upset the growth in the economy. And I think the downgrading in the GDP number, although by 20 basis points is a very moderate number, I think the markets are looking at a much sharper kind of drop in the GDP. So we'll have to wait and watch for at least a couple of quarters. So I think net, the market was not happy with this, because the overall economic picture seems to be quite cloudy.
Stay with us, Avinash. We also have Vivek, Kumar, economist at Quantico, joining us this morning. Vivek, good morning. Help us understand, what are your first views on reduced growth from 6.7% to 6.5%. Again, perhaps on expected lines, inflation likely to come under 4%, and that is, or exactly at 4% is the RBI's projection. And the change in policy stance moving from neutral to accommodative, which means a status quo or further rate cuts, but definitely no rate hike expected, no matter what inflation does in the US and what India imports on the inflation front.
Hi, good morning, and thanks for having me back on the show. I think it's completely along the change of stance, the 25 basis points cut on repo rate, along with the change in the forecast. So our Quantico forecast recently, after the announcement of the Liberation Day tariff changes by the US, we had also slashed our GDP growth forecast by 30 basis points from 6.7 to 6.4%. We also brought down our CPI inflation forecast from 4.3 to 4.1%. So we are broadly in line with what the RBI is projecting. And we are completely sympathetic and empathetic to what has been the undertone of the policy announcement, because we are operating in a heightened global uncertain backdrop triggered by the weaponization of sanctions by the weaponization of tariffs by the US administration. And this has actually no immediate to compare. So, one can understand when the governor says that there are too many risks at the moment. Yeah. And from the inflation point that you made, I think, yes, there are both upside as well as downside risks. And the upside essentially comes from the unknown risks that global trade upheavals will bring about. But at the same time, there is side pressure on commodity prices. And for example, crude oil prices, we import nearly as much as 80% of our crude requirement from global markets. And a steep slide, almost as much as $10 in a span of less than a week, bodes well for our inflation outlook. As recent as yesterday, the private weather forecasting agency SkyMet came out with their update on monsoon forecast. They expect the monsoon in the upcoming southwest monsoon season to be at 103%, which essentially means that you could look at a marginal surplus rainfall in the over the course of June and September months. And this also kind of gives you that comfort that the governor has been talking about. Yes, there will be some risks from the international spillover side, but domestically, I think looking at where monsoon is, looking at where commodity prices are headed, it gives you that room, that maneuvering space to start addressing growth in a much more meaningful manner.
All right, Vivek. Avinash, let me bring you back into this conversation. And while we were speaking, the RBI governor has also mentioned that there are likely to be changes now to the NPCI, the National Payment Corporation of India, and it's likely to revise transaction limits on person-to-merchant payments. The current limit is about 2 lakh rupees, exactly 2 lakh rupees, and there's likely to be some revision in that. I think we are talking about UPI payments now, and NPCI being the custodian of those UPI payments. How is that likely to impact either the BFSI space or even the sentiment on consumption going forward?
No, I think it's a welcome move, and I think going forward, the transaction limit increase will definitely help the business community and individual savers as well as investors. So I think it may not have an immediate impact on the markets or the business transaction as a whole, but I think the overall economic climate will definitely change, and digitization, which has taken off in a big way, will further get a boost. So I think we are positive on this for the longer term. And I think it's a welcome move. I think this will definitely benefit, all the users who actually opt for digitization and actually are obviously users of the UPI kind of, module.
Avinash, well, let's also look at the mood of the markets right now as you're speaking. Nifty and Sensex are both sliding. Well, just for being doubly sure, this doesn't have much to do with the announcements coming from RBI Governor Sanjay Malhotra, but this is the tariff war that has been started by none other than US President Donald Trump, and that war now escalating across the world, especially heating up with China. Asian markets have been hit badly again today in trade. India not being left behind as well. And just about an hour ago or so, as it struck midnight in Washington, in the US, tariffs have come into play. 26% tariffs on Indian exports have also kicked in. Avinash, this is pure play trade war which is now on. Well, perhaps it may not be an overstatement to suggest that the trade war has been initiated for China to be checked by US, but India also happens to be in the wake of that tariff war and perhaps collateral damage right now.
No, exactly. I think, the tariff war has started, and I think, we'll have to wait and watch how this pans out. But I think in the very near term, short term, pain is going to be there. We are going to see a lot of export companies getting impacted because especially, companies which are in the auto component space, IT space, pharma space, gems and jewelry space, these are sectors which contribute significantly to the Indian export basket. And I think for the near term, at least a couple of quarters, you're going to see margin getting compressed because pricing changes may not happen overnight. I think there have been many companies which have got export orders, but with this tariff of 25%, on imported cars, on gems and jewelry, I think that is definitely not a good, development. The focus of the markets would obviously move on the domestic themes like infrastructure, cement, consumption, where I think the question of tariffs are not going to come in. And I think the banking sector, as I was telling you earlier, it presents a good opportunity for long-term investors to look at this basket because the domestic market is going to see a good amount of growth. So, financials, especially from the NBFC space, public sector banks, private sector banks could definitely be good opportunities. But I think, yes, the broader index is going to be very volatile and choppy. You'll have to take a stock specific call. And I think as result season is just getting started from tomorrow, I think you're going to see a lot of stock specific activity from now on.
All right, stock specific activity likely to take forward from now on. Vivek, come back into this discussion and tell us, RBI Governor Sanjay Malhotra there saying that tariffs will have a negative impact on growth, but that negative impact of just about 0.2% or 20 basis points, is that the RBI Governor being too optimistic on India's fundamental strength, or is there more to read into it?
It's a difficult question to answer upfront so early on because, the tariffs got implemented just on April 9th, which is today. And there are a lot of moving parts in this discussion, in this episode. And one of the most important moving parts is that, yes, we got slapped by a 26% tariff, which is almost more than double, you could say, of what the street was expecting before the announcement. I would say the consolation is that some of your peers in the competing exporting industry, they have received an even harsher treatment from the US. So talk about China. China now faces nearly slightly over 100% tariff rate since yesterday. And Vietnam, Bangladesh, Cambodia, so some of the competing industries, whether it is in the area of toys, whether it is in the area of textiles, leather, maybe to some extent, you would see a lot of, I would say, India's market share, gains in India market share at the expense of some of these peers. Now, again, it is a statement that one is able to make at this point in time, assuming that the current status quo holds, which is that no other country is able to negotiate. But then over the course of next 1 to 3 months, barring China, there is a very high likelihood that most of the other countries will also negotiate along with India. So India has already sounded off its intention to go ahead with the BTA. And with the announcement now, probably the speed with which the BTA gets implemented, you will see a leg up in that. So most of the key countries, barring China, will negotiate their way out of this. They'll try and reduce the impact of tariff. And hopefully what we are seeing right now, or what we are feeling right now in terms of the negative news, is the worst case scenario. The actual scenario 2 quarters down the line could be somewhat better than what it is right now. So that's one part. The second part is that I think in case of India, most of the impact on GDP which the RBI talked about essentially stems from the fact that it's a negative spillover that they are taking into account. So there is probably no direct impact, which we have also not taken into account in our GDP growth revisions. We believe that the positives and the negatives for India are going to offset each other by and large. It's the uncertainty, which the governor also alluded to, at a global level, which will be dampening the growth impulses. So, if global growth itself falls by 50 basis points or 80 basis points over the course of next 12 months, it is very likely that India's growth also sees a 20, 30 basis points downward movement over the course of next 12.
All right. Avinash, take us through what you feel about how India has, despite being collateral damage, so to speak, has been let off a little easier than other Asian peers. Look at China. China, starting today, is now staring at 104% tariff on all Chinese exports going into the US. Look at other neighboring countries like Bangladesh and Vietnam that Vivek was talking about, and hence the impact on Indian markets has also been much more timid and much more easy to digest as compared to what is happening in rest of Asia, and not just Asia, even European markets for that matter.
No, I think you're right in mentioning these data points. I think India has been fortunate that the tariff has been put out at 26%. If you compare the other Asian countries like Bangladesh or Sri Lanka, I think they definitely have been imposed a higher tariff. Vietnam has got a higher tariff, almost 45 to 46%. So I think, to that extent, India seems to be insulated. And plus, the Indian economy is not a purely export-driven economy, so we are not that badly impacted. More so, the crude oil prices for us, if they come down, that is definitely a big positive because almost 75 to 80% of our requirements are imported. So I think clearly, this is definitely going to help us, balance our trade deficit in a much better way. But I think the clear, negative could be coming in for the export-oriented companies. I think companies which are into large exports to the US market, especially pharma companies, auto component companies, IT service companies, these are problem areas, and possibly, the market attention would now come on the domestic themes because that is where possibly the safety and margin of safety is very much evident. So I think, yes, to a large extent we have been insulated, but I think we can't get away from the fact that if the global economy goes into a recession and if global GDP comes down, then India cannot remain unaffected. So, we'll have to take it in our stride. And I think next couple of come to know what kind of impact the tariffs are going to make on the US market, because mind you, US is also going to bear a lot of short-term pain. If there are job losses, if unemployment increases in the US, that's going to create a little bit of problem for the US markets also. So I think it's probably a better decision to just wait and watch and be very selective now when you want to allocate your capital.
So when you're talking about capital allocation, Avinash, there is also news. In fact, gold prices have also softened, and that is a little counterintuitive because stock markets in the US are also tanking, and usually when stock markets tank, gold is expected to go higher, but gold has also softened to below $3,000 an ounce in the US, and even the dollar index is actually now just about in the 104, 105 levels, well below the peak that we had seen earlier. So help us understand and explain to our viewers what is really going on with dollar also softening, gold also not at lifetime highs, and markets crashing as well. So what happens to asset allocation at a time like this?
No, I think my sense is the gold prices had gone up significantly in a very short period of time. So obviously some profit booking had to come in. But if you ask me about the dollar index, I think one clear indication which is coming out after the tariff measures announced by the US President Donald Trump is that many countries now don't want to treat the dollar as the mainline currency. And if that happens, then the dollar can possibly, see a little bit of value diminution, which maybe in the short term may not be possible. But in the longer term, if countries try to ignore the dollar and try to promote other currencies, then I think that will definitely have an impact on the dollar as a frontline currency. So, this is one of the key reasons why the dollar index is softening. And most importantly, I think unless and until we see the real impact of tariffs, because other countries like Europe, for that reason, Canada, Mexico, all these countries have voiced their opinion that they now want to change their trading pattern. While this may not be possible in the short term, in the longer term, clearly this is a very distinct trend. And if this happens, then I think, that is going to impact the currency value, especially for the dollar. So I think that is clearly the reason why even gold is getting impacted and the dollar index is little ruling weak.
All right. And also put in context, what happens now to foreign investors at a time when India's interest rate is coming down and it has now been slashed to 6%. So interest rate in India comes down, but inflation in the US is likely to perhaps get US Fed to become more hawkish and over time increase interest rates. So what happens to flow of capital, especially foreign capital, in a scenario like one which may play out in a few weeks or months from now?
No, I think markets and FIs are going to clearly look at very strong data points from the corporate sector performances. See, I think clearly the FI money will go into those sectors where growth continues to be very strong, where visibility of earnings is very assured. So I think, FI money will come in, but it will come slowly, probably after the April to June quarter, when, market gets a sense from the corporates that whatever announcements have been made by the government in the budget, the 2 rate cuts which have been announced by the governor, obviously all that will get reflected in a better consumption kind of recovery. And most importantly, domestic sector still continue to do well. So my sense is that post the June quarter, I think you can see a gradual increase in the FI flows. And I think, you'll have to also understand the fact that corporate, performances have been very cloudy. So March quarter is not going to be great. So I think, cement, infra, capital goods, consumption, hotels and hospitality, hospitals, these are sectors where I think growth will come in. So I think we'll have to wait and watch for some time. But I think in the second half of this year, we could see the FI flow coming in more convincingly.
All right, Avinash, Gorakshakar, Vivek, Kumar, thank you so much for joining us this morning. We will slip into a short break at this moment, but joining us on the other side will be the Chief Economist at Yes Bank, Indranil. You are watching News 9 and we are bringing you the special coverage of the outcome of the Reserve Bank of India's first Monetary Policy Committee meet of FY26.
This is India's #1 news network, and you're watching News 9.
What does it take to be the greatest in the world? There is one thing which truly sets you apart. Your inner strength. Sodyadev DMT Reebok. True inner strength.
I need expert performance. I need my career.
Smash your way to glory at the News 9 Corporate Badminton Championship. Get ready for the ultimate badminton showdown. News 9 presents the biggest corporate championship, a battle of skill, speed and supremacy. Cash prize of 6 lakh rupees across categories. Venue, Pulela Gopichand Badminton Academy, Hyderabad. Dates, May 9th to May 11th. A chance to showcase your talent and make a mark. The court is set. Are you ready? Register now.
This is India's #1 news network, and you're watching News 9. English news as it should be.
Welcome back. We have with us now Indranil, Chief Economist at Yes Bank, joining us. But first up, let's bring you the updates of the first Monetary Policy Committee meet of FY26 just concluded, where RBI Governor Sanjay Malhotra was speaking there on your screen. The unanimous decision to cut repo rate, India's key interest lending rate, from 6.25% down by 25 basis points to 6%. So the new repo rate now stands at 6%. There has also been a downward revision in India's GDP growth projection for this financial year, down from the February projection of 6.7%, now revised down by 20 basis points to just 6.5%. Inflation, on the other hand, despite the RBI Governor Sanjay Malhotra saying that India may be importing inflation from the US, but despite that, a healthy monsoon likely to come this year, India's inflation outlook for FY26 is now stacked up at about 4% for this financial year. And most importantly, there's been a change in stance, and the Reserve Bank of India has changed its policy stance stance from neutral to accommodative, which means any fear of a rate hike by the RBI despite imported inflation now put to rest, at best a status quo if not further rate cuts expected. Indranil Pan, Chief Economist, Yes Bank, with us now. Mr. Pan, thank you so much for being here with us on News 9. Tell us, what do you make of inflation now, despite what we are likely to see in the US and chances of imported inflation hitting India? Inflation projection revised downwards to just 4%. Does that seem realistic to you, sir?
Absolutely. In fact, our projection on inflation is slightly lower. First of all, as the governor rightly pointed out, there has been a sharp correction in the vegetable prices, and which has really sort of reduced the inflation print in the last reading that we saw to 3.6%. Going forward, for the current month, we expect inflation to be more or less in a similar range. And we are sort of also looking at inflation anchored around the 4% level. Now, what the governor also possibly bases his inflation projections is the fact that the Rabi is relatively good. The wheat output has been good. That's what he pointed out. And given that the SkyMet has announced for a relatively good monsoon, which necessarily means that the Kharif production shouldn't also be a problem. And all these factors taken together can actually push inflation towards the 4% on a more durable basis. So in terms of inflation, I think it was warranted that the inflation projections is brought down, which also necessarily means that room for rate cuts have actually opened up as inflation has been on a lower side. Now, you did point out to the global implications of inflation. Yep. The good part over there is the core inflation, which is the core retail inflation, does not have too much of a shadow of the global the goods inflation or the imported inflation. Right. It is more on the services side. On the other hand, the crude and the other commodity prices have also fallen, reflecting the weaker demand globally. And that should be relatively positive for our inflation too.
All right. And also talk to us about the growth projection, now revised downwards from 6.7% to 6.5%. Remember, 6.7% was the number that the RBI had projected in the month of February in the last MPC. And now that has been revised by just 20 basis points downwards to 6.5%. Given that there is a higher probability now of US slipping into recession, a direct impact on a lot of Asian economies, China being one, Japan, South Korea, Taiwan, do you think India will be spared to some extent, and hence the RBI is projecting just a 20 basis point reduction in growth outlook for India?
I think in terms of our exposure to US on a direct basis, if I look at the domestic sort of exports to the US as a proportion of GDP, including the pharma sector, it's just about 1.6%. Excluding the pharma sector, it is about 1.3%. Now, which necessarily means that even if we see a 5% drop in the overall exports of the country, the relative growth hit on a direct basis could be around 0.2%. Right. What really, however, is worrying is what is the impact of the tariff on global growth, because let us do remember that almost 18% of our overall exports goes to US and another 18% to the European region. And are sort of showing tentative signs of a slowdown, and there are expectations that US would actually slip into a recession. So all that taken together, I think the growth sort of downswing from the earlier 6.7% purely from external factors could be slightly higher than the 0.2%. But having said that, we would see the sort of lower inflation, especially in the food, to provide some more avenue to the domestic consumers to move into discretionary, something that was not happening when food inflation was on the higher side. Tax cuts also take effect from the 1st of April, as was announced in the union budget. And last but not the least, the RBI is cutting interest rates which also should, over time, over a 6 to 9 month period, filter into the economy in terms of lower borrowing costs, and that should also provide a fillip to not only the domestic consumption, but maybe also the domestic investment cycle.
Right, and corporate earnings season kicks in from tomorrow. I don't really want to talk about the gone by quarter, Mr. Pan. We are quickly, we are running out of time, so I'll request a quick answer on that. What do you expect for Q1 of FY26 on the domestic consumption front, given that interest rate has come down, money may not go into banks, markets are tanking, maybe no fresh investments, and an income tax relief which kicks in from the 1st of April. How's all of that going to bode for corporate earnings and domestic consumption in Q1 and henceforth for the rest of the financial year, sir?
So as I explained, the domestic consumption story looks relatively better. One, on the back of relatively good agricultural production, both direct and indirect. Inflation has been coming down, which should be positive for domestic consumption, and interest rate cuts are happening. In terms of the corporate balance sheet and the profitability, I think there could be some sectors who would face a sort of tightness in terms of margins going forward, simply because their input costs could actually rise given the deflationary pressure, and we are still yet to see global inflation, in the sense that we really do not know what is the tightness in the supply chains that happen and sort of boost up the global commodity prices. Today, the behavior on the global commodity prices is just from the recessionary angle, but there could be other sort of perspectives in terms of supply chain distortions, which can actually provide a downside sort of limitation to which the global commodity prices can react lower.
All right.
So those things taken together, there can be hit in terms of the balance sheet and the profitability of certain companies.
All right, Dr. Pan, thank you so much, sir, joining us this morning on this very important development coming from the RBI. We will leave it at that, but thank you so much for being here with us. Time for a break now. News continues on the other side. You are watching News 9.
This is India's #1 news network, and you're watching News 9. English news.
What does it take to be the greatest in the world? There is one thing which truly sets you apart. Your inner strength. Sudhir TMT Reebok, true inner strength.
Smash your way to glory at the News